Kotak Nifty 100 low volatility 30 ETF. Will this ETF help you create long-term wealth? Will this ETF help you achieve all your financial goals? Let us evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before analyzing this particular ETF NFO, let us understand the key features and some background information about this NFO. This NFO is open till 22nd March 2022. And this particular ETF's minimum investment is just 5,000 rupees during NFO. And this follows the benchmark of Nifty 100 low volatility 30 total return index. This comes as an ETF, exchange traded fund. The investment objective of this fund is to provide returns which is almost equivalent to Nifty 100 low volatility 30 index, subject to expense ratio and tracking error. Right? This fund will simply mimic, replicate, and mirror Nifty 100 low volatility 30 index. So, Nifty 100 low volatility 30 index is basically out of Nifty 100 stocks, top 100 large cap stocks, 30 stocks are chosen based on volatility. Whatever the stocks has got low volatility, that is taken into this index. So out of 100, 30 low volatile stocks are chosen. That is why this is known as low cost smart beta index. So this fund will track the index and deliver similar returns as of index. There is no other advanced investment strategy here. Simple plain vanilla index fund passive investment strategy. Let us analyze this index a bit more. What are all the companies in this index? Top 10 holdings are Dabur India, Britannia Industries, Nestle India, Hindustan Unilever, Tata Consultancy Service, Bajaj Auto, Hero Moto, Marico, Infosys, and Cipla. These are all the top constituents, top 10 holdings of this particular low volatility index. How sectorally diversified this particular index is? Consumer goods 33%, IT 15%. It also has exposure to financial services, automobile, oil and gas, pharma, power, cement, construction, chemicals. So this particular index is well diversified into multiple sectors. This particular index is not a concentrated index. This is a diversified index, obviously. And what is the kind of past performance this particular index has delivered in the past? From January to February so far, the first 2 months of this particular 2022 year, this fund has delivered minus 5.31% in negative return because market itself is volatile. So it has delivered you 5.31% in negative return. In the last 1 year, this particular index has delivered 16.40% return. In the last 5 years, the CAGR annualized return is 14.73% return. So this is an equity fund. As it is an equity fund, you have to invest only for long term. When I say long term, it means 7 years plus, right? Not less than 7 years. Just looking at last 1 year return of 16.40%, we should not get carried away and expect similar returns in future also. No, only if you have 7 year plus time frame, please consider this fund. As we have understood the key features of this fund and also we have analyzed the outlook of this particular index, let us evaluate this particular ETF. When we did our research analysis, what are all the key findings which are in favor of this particular fund? What are all the pros, advantages, potential merits to this ETF? Let us look at it. This fund invests in a diversified portfolio that are likely to deliver long-term growth with minimal volatility. Yeah, that is the aim of this particular index. Diversified at the same time, low volatility. If you look at the top names, definitely they are all strong, fundamentally strong companies. Most of the companies are. And suitable for ultra conservative investors looking to add passive investments to their core portfolio. Someone who is not willing to invest in actively managed funds, who is very conservative, at the same time they want to have equity exposure, then they can try this Kotak Nifty 100 low volatility 30 ETF. Compared to actively managed fund, the returns from this fund are relatively stable with less volatility. All right, because they are picking and choosing top 30 less volatile stocks in the index itself. 30 stocks are not picked or chosen by the fund manager. The index itself is constructed in such a way that it is pre-chosen the 30 low volatile stocks. So that way, this will be more stable compared to an actively managed fund. In this fund, the fund manager is not going to take any stock selection decision. Whatever the stocks which are there in the Nifty 100 low volatility 30 index, is simply going to mimic and replicate all the 30 stocks in his portfolio in the same weightage he is going to do. So this fund is free from the fund manager bias. There is no stock selection risk here. These are all the potential advantages of this fund, and there are some more advantages to it. Low volatile companies are, like most of the times, are fundamentally strong business models, and because it is a passively managed fund, it is expected to have low expense ratio. It is expected to have low expense ratio compared to an actively managed fund. We have looked at the advantages, pros of this fund. Now let us move on to the potential demerits. When we analyzed this particular ETF, what are all the key observations which are against, not in favor of this ETF? Let us look at it. Obviously, it is an equity ETF, so it is not suitable for short-term investors. 7-year plus time horizon should have. If you have short-term money, don't try this ETF. This fund, being an index ETF, because of its expense ratio and tracking error, there is a high probability it may underperform the respective benchmark index. So this will not even deliver the index returns. It is expected to deliver slightly lower return than the index. Being an index fund, the duty of the index fund is to simply mimic the index and deliver similar returns. So it will not beat the index. In the actively managed funds, the fund manager will pick and choose the best stocks from the index. So as he picks and chooses the best stocks from the index, the actively managed funds has got higher probability to beat the index. Here there is no such thing. Here there is no alpha generation. This fund is not expected to deliver higher return than the index. This will not beat the market. Actively managed fund managers, based on the outlook, they can move the weightage from one sector to other sector. If financial services is doing well, he can go overweight there. If consumer goods are doing well later, he can move from financial services to consumer goods. Whereas in this index fund, even if the fund manager has got an outlook that consumer goods will do well, he can't simply move the weightage from financial services to consumer goods, because in this particular ETF, their mandate is to simply follow the index. Whatever the allocation given for financial services in the index, they have to follow same weightage, same set of stocks. So fund manager cannot dynamically manage this fund. Being an index fund, the fund manager will not do any analysis on the underlying stocks. They will simply blindly buy all the stocks in the index. There is no calculated risk here. Here it is completely a blind risk. The fund manager will not look at the balance sheet, profitability, sustainability of the company, management quality. Nothing is considered here. The entire index is bought by the fund manager. Active funds in comparison can take calculated risk because they will analyze the profitability, balance sheet, sustainability, and management quality. Everything will be analyzed and they will be choosing the best stocks based on their score, right? So here the fund manager, actively managed funds, the fund manager will be taking more calculated risk. Here we are taking blind risk comparatively. And tracking error is one of the major drawbacks of any index fund. And during market crash or when the market touching all-time high, the fund manager cannot move the stocks into defensive stocks or into aggressive stocks based on the outlook. He can't take any course correction or proactive measure. He will not be able to do. So that is another drawback of this particular ETF. So as an investor, will this ETF is good or bad for your portfolio? It depends upon what kind of investor are you. This is suitable for an ultra conservative investor who is not willing to invest in actively managed funds. Right? There are similar index funds that have a lower expense ratio and a low tracking error. Whereas the ability to maintain low expense ratio and the ability to have low tracking error of this Kotak Nifty 100 low volatility 30 ETF is yet to be tested. It is untested. So why should we risk here when we have tested and proven funds? Actively managed funds have got higher potential to deliver better returns than this passively managed fund. Investors expecting dynamic fund management and looking for investments that can beat the market definitely should avoid this fund. If you have any questions related to this particular ETF or any other investment option, feel free to book a free appointment with our financial planner. The link for booking the free appointment is given in the description of this video. By the way, will you be interested to attend insightful investment webinars? The link for the upcoming webinar is also available in the description box. We regularly organize insightful investment webinars to help investors create long-term wealth. So please register for the upcoming webinar. If you're not subscribed to our YouTube channel so far, please subscribe now. Thank you. Bye.